Hello and welcome. My name is Eric Wilson with Freedom Venture Investments, and today we're going to be talking about the tax benefits of real estate. And really, what we're going to be trying to answer today is, what are those tax benefits? Everyone talks about the tax benefits of real estate. You've heard it before. I invest in real estate for the tax benefits. This syndication has incredible tax benefits. Let's take a look at this. But really, what are those? What are those tax benefits? What are people talking about when they say, I'm looking to invest in real estate for the tax benefits? Couple of things that you should get out of this webinar. The first thing we're going to talk about is we're going to talk about some strategic tax planning. So this encompasses everything from, at the property level, when a GP is setting up a syndication, when you're creating an offering to put out to investors, and also for potential investors, to consider an investment, doing your own personal strategic tax planning. Does this investment make sense given my personal tax situation? And it goes without saying, but I meant to say this right when we started the webinar. I'm not a CPA. I'm not giving anyone tax advice on this webinar. I'm just a guy who invests in real estate. So this is by no means investment advice. It's not, I'm not a CPA. Please don't take this as advice, but I'm going to share some experiences that I've had, and I'm going to share the experiences of people that I've invested with, so you can kind of learn from these experiences and leverage that experience to make your own informed decisions. We're going to dive into depreciation. A lot of people probably know that depreciation is one of the biggest benefits of real estate. Um, Real estate is not like buying a car where you drive it off the lot and it depreciates immediately, and you lose a significant amount of that value. But the government does recognize that property has a shelf life to it. It will depreciate over time, and they allow us to basically write off some of that cost over a certain amount of time of the useful life of that property. And there are ways that we can, work the depreciation in our favor. There's a lot of nuances to the depreciation, where we can really structure it so that we're getting the most tax efficiency for our business plan for that specific property. So we'll dive into that a bit. And then we'll talk a little bit about the standard tax deductions that you'll see in various real estate investments and some of the common tax credits that you'll see. Um, but before we get started, I will just go over quickly the agenda. I will hit on some of the fundamentals. I start most of our webinars with the fundamentals of real estate syndication. This will be a condensed version, so that we're all speaking the same language. I'm just going to start and give a real quick overview. Then we'll get into that tax planning that I was talking about, the depreciation, some of those advanced depreciation strategies, such as cost segregation, maybe some bonus depreciation, how you can leverage those tax credits that are out in the marketplace. And then we'll go into some specific investor-specific tax implications, how these things can be, utilized from a limited partner, from a GP, whatever your standpoint is as a real estate investor. I'm going to go over several different scenarios, and maybe some of these scenarios apply to your situation. We're going to go over some real world case studies. I'll try and leave some time for some Q&A. I think we'll have plenty of time at the end of this webinar. I'm going to try and wrap it up a little bit before we have our full time here. And then I'll end the webinar talking about Freedom Venture Investments, what we're currently focused on, and some of the tax advantages that we're experiencing with some of our investments. Before I jump into the content and meat of this presentation, just want to go over who I am for those of you who are just joining us for the first time. My name is Eric Wilson. I'm a co-founder and managing partner of Freedom Venture Investments. Got my start in real estate back in 2016, back when I was still working at Fidelity Investments. Real estate was a side gig for me. It was something that I was doing to increase my passive income. It ended up becoming my full-time job. I got very entrenched into the nitty-gritty of the world. I really fell in love with it. I'm sure some of you have a similar sort of story. But now today I've raised over 350 million in equity, and we're managing a portfolio exceeding 500 million. I am experienced in both the GP and LP roles. So being a GP with Freedom Venture, I see a lot of deals. We invest in a lot of deals where we are the lead sponsor. We also invest as an LP, both individually and as a company. So when people come to us, they're presenting deals in Texas, maybe the Carolinas, Tennessee. and they're looking for an investment from us, we're evaluating them as the GP, just like investors evaluate us as the GP. So I think we have a pretty unique perspective on evaluating opportunities. And then I have some unique insight because we now have over 500 investor partners with us. And I talk to a lot of these investor partners. Pretty much all of our investor partners have talked to me at some point. So I get to share stories and share experiences, a lot of different backgrounds with our investor partners. Some are high earning professionals, some are business owners, some are family offices. They all have very unique tax strategies. And I've learned a ton just from the real world application of having conversation with my investor partners, with you all, many that are on this call. So I thank you for all the education that you provided with me. And I'd like to use this format to share some of that information back with the rest of the community. For those of you, again, joining us for, one of the first times that you've seen one of these webinars, we're going to quickly go over the format of private equity real estate and the players that are involved. You've already heard me talk about the GP and the LP. What are those? Well, the active partner in any private equity syndication is the GP. So this is the person who is the operating partner. They're responsible for going out and finding the deal. They're responsible for executing the business plan, raising the capital, sourcing the debt, managing the entire life cycle of the investment. That falls on the shoulders of the GP. Like I said, it's the operating partner, controls the property and the entity operations. And then you have passive partners. So the GP will put up some money for every single syndication. And then the LP, the passive partners, will come in as silent capital partners. So if you think about it on a small scale, if there's $1 million property that I'm looking to buy, maybe I'll put down $200,000 and we're going to buy this thing in all cash and I need $800,000 to purchase the rest of the property. I'll raise $800,000 from LPs, from passive partners, people who trust the business plan that I've put in front of them and they like the property, they like the location, so they put their capital into the project. They're now silent partners. They get all the direct benefits of owning the real estate through the LLC that we've created, but they don't have to deal with the management, the property management headaches, all of the things that go with actually managing the property for the day to day, and making the big decisions as for when to refinance the property and when to exit or dispose of the property. And there are two main types of passive partners that we work with. We work with primarily accredited investors, so individuals who earn at least $200,000 per year or $300,000 jointly as a couple, or have a net worth exceeding $1 million, excluding primary residence. And then there's also non-accredited investors, and we have some options that work for non-accredited investors as well. Some of the benefits of private equity real estate include diversification. It can be a reliable stream of income. It can be a strong inflation hedge, tax efficiency. That's why we're on the webinar today. You see this again on every offering, every real estate syndication out there. They're going to tout some sort of tax benefits. Today, we're going to be diving into what are those tax benefits and how can you identify them for every syndication that's out there. And then when you account for, the tax efficiency, the tax advantages, the risk, you can actually get some seriously high absolute returns through private equity real estate. And as a small piece of your overall portfolio, it can still reduce your portfolio volatility. So just a basic definition of what private equity real estate is. Private equity real estate is a collective investment scheme that pools capital from investors to acquire, manage, or develop real estate properties. This asset class continues to involve active management strategies to enhance property values and generate higher returns. There are two main ways that we as a company facilitate private equity real estate, and that's through either fund structures, which encompasses multiple properties through one investment, or a syndication, which is a very common term that is out there in the marketplace. Um, and that's for typically a single property. You know exactly what asset you're buying. It's one investment for one property. There are pros and cons to both of these strategies. Some people like to pick and choose exactly where their capital is going on each property. They may do 15 syndications in a year. I've certainly seen that before. Some people say, I would still like to buy, allocate X amount of capital towards real estate, but I only want to make one investment, and I like the strategy of this fund. I'm going to make one investment with this fund. It's going to simplify my tax reporting at the end of the year. It's really a personal preference thing. There are pros and cons to both strategies, but we offer both at Freedom Venture. Syndication is going to be what we talk about today. It's a little bit simpler to understand and discuss. Syndication refers to a partnership where multiple investors pool their resources to invest in a property. This collective approach allows individuals to participate in larger real estate investments and projects. So going back to the example of the $1 million project that I said earlier, that would be a syndication. I put up some capital as the GP, and then LPs put up capital, and we're all now partners on this one property. Benefits for the investors gives you access to larger deals, so deals that you may not be able to access yourself. Um, Potentially some higher quality institutional assets. You get to diversify some of that risk because you're leaning on the expertise of the management team and the professionals that have done this over and over again and really specialized in the product type that they're investing in. Benefits for GPs like myself, it allows us access to more capital, so we can expand our portfolio faster than we would be able to do just by ourselves. When we got started, it was just three partners, and we joined with the same concept. We could invest more proficiently together as three partners, whereas versus just doing it individually as three individuals. So same concept. Now we have over 500 partners, and we can expand, much more significantly. And then we're incentivized through performance incentives. So we're investing our capital into every single deal that we put in front of our investors. So we're incentivized so that our capital grows, but we're also incentivized because once we hit certain hurdles, maybe it's an 8% hurdle or a 10% hurdle, we'll actually get an additional incentive bonus for achieving that hurdle and making sure that our partners are getting the returns that they desire. All right. Now that the fundamentals are out of the way, we're going to dive into the actual tax benefits. And like I said when we started this webinar, we are trying to answer that question of what are the actual tax benefits of investing in a real estate syndication? This could be broken up into probably easily 5 or 6 webinars. There are many topics that we won't be able to get to in depth, but we're going to try and hit as many of these topics as we can, and we're going to make sure that we can try and hit the high points so that when you look at an offering, you can ask the sponsor, "What's your tax planning strategy?" And when he answers, you're going to have an understanding of what they're talking about, and then you can go to your CPA and you can talk about if this makes sense given your personal tax situation for the upcoming years. So real estate investing offers a unique array of tax benefits, making it one of the most tax efficient investment vehicles available. These advantages can significantly enhance investment returns by reducing taxable income and increasing cash flow. Some of those benefits include depreciation, cost segregation, which is a form of accelerated depreciation, 1031 exchange, which is a way to defer capital gains on investment properties when you transfer those gains into another like-kind property, and then pass through deductions that can reduce your taxable exposure. Very, very simple concept here, just so we're all, looking at the same thing here. If you have a situation where there's income of $250,000 and you're in the, say, 35% tax bracket, you would have a taxable exposure of $87,000. Through some of the, benefits of real estate, through depreciation, interest, expenses, let's say that amounts to $30,000. That will adjust your taxable exposure to 220,000, reducing your liability to 77,000. And that's a total tax savings of $10,000. So again, these are, through the benefits that are associated with real estate, you're able to reduce your taxable exposure. This is a concept I'm sure everyone that's on this webinar is extremely familiar with, and you want to dive into the details, but I just have to get everyone up to speed with what exactly we're talking about. This is what we're talking about, saving on the taxable exposure. If you're someone who maybe invested in a syndication, put $100,000 into an investment and you had an 8% return, what does that 8% return really mean once you actually consider the tax benefits that you're receiving? So yeah, it's a cash value of $8,000 per year. But if like in that previous example, if we were able to save $10,500 on our overall tax liability because of the benefits that of our investment, we're actually seeing a much greater return because that's capital that we would have had to pay to the government, but because of the tax code that's available to us and simply leveraging the tools that are there for us to use, we're able to keep that capital in our pocket. So that's effectively a total return with those tax benefits included. So if you calculate that into your return, yeah, it's an 8% return without the tax benefits. But if you're someone who looks at your entire financial picture, and you should, that one investment is actually saving you that additional 10%. So you're getting an 18.5% return on that investment. It's one way of looking at it. Another way of looking at it, again, I'm just trying to drive home the a significance of the tax planning because I'll tell you when I first started buying real estate, tax planning was not my focus. I didn't start investing in real estate because I was such a high income earner. I was investing in real estate because I was looking to make smart moves. I was buying three family houses. I was living in one unit, renting out the other two units. That was my strategy when I first got started in real estate. So it wasn't until I started to sell some of the properties that I had that I started to really understand the impact and some of the strategies that these make. And when you're just, having to hand over a significant chunk of change to the government when you could be reinvesting that capital, it can seriously impact you. So you want to make sure that you're doing proficient tax planning. Again, I'm sure everyone on this call knows this, but just to drive that home, if you had $100,000 that would have gone to the government, but you're able to keep it for yourself and invest that capital at 5% compounded over 30 years would be worth over $400,000. Similar scenario, we're taking $100,000 invested at 6% over 30 years. I know these colors aren't great to see. It's not showing up that well in the PowerPoint, but this is that $100,000 invested at that 6% return, but being taxed at 40%. If it was taxed at 20%, we're increasing that value to over $400,000. If we're investing tax deferred, and we'll show you ways to do that, that capital has now become almost $600,000. So again, keeping additional capital in your pocket, reinvesting it, it can have a serious impact on the bottom line of your investment and really change your overall financial picture. This is just about the importance of tax planning, and really, it's pivotal in real estate syndication because it gives you more opportunities for growth and to optimize the investments that you're making. Some of the reasons that you would want to sit down every single year with your CPA and be looking at your tax planning strategy, really looking at the syndications, enhanced returns, like we just discussed, investment longevity, reduces your risk. It's a risk to, have a big tax bill coming around the corner and you didn't know it was coming, and now you're on the hook for a significant chunk of change that you owe. So having a proficient tax planning is a way to mitigate that risk. And then also, regulatory compliance, making sure that you're doing things the right way and you're not, the IRS will come knocking if you're not sticking to the rules. So let's leave it at that. And then as a GP, it's attractive for investors to want to invest with someone who knows what they're doing with the tax code and has a full accounting team, has professionals, CPAs that specialize in our asset class, who know how to work with these syndications. That's what we do. We work with the professionals. I don't need to know every single line of the tax code. I need to know enough to make smart business decisions. I need to have the professionals that we work with as a company sitting in the same room as me, and we go through every single one of our investments and every single one of our transactions so that we can make the most informed decisions. That's attractive from an investor standpoint. So if you're a GP on this call and you're, looking to raise capital for your own investments, becoming solid at your tax planning, understanding the rules, and understanding the benefits and the different scenarios of how it could impact your investors could help you attract additional capital to your properties. There are several ways to structure different syndications, and I've talked about this before on the webinars, and I've hinted at, we do it in a certain way for tax efficiency. But today I'm going to go over the different options that are available. I'm really going to go over the main structure that, or one of the main structures that we use and why we use it for tax efficiency. So LLC is one of the most common ways to invest in a syndication. LLCs are great because they're flexible in the way that they're taxed. They can be taxed as a partnership, they can be taxed as an S corp or C corp. It really depends on what's going to be most beneficial for the syndication. So having an LLC is very it's very flexible. LP, limited partnership. So partnerships are really the best way for passive investors to invest. Now, this is from a tax standpoint. You can still invest into an LLC that's taxed as a partnership, and you're going to get those tax benefits. But a lot you may see, offerings out there that are, still put out as LP, as partnerships. And that's definitely possible. The terms GP and LP come from that general partner, limited partner structure of a limited partnership. And then you have an S corp. You could use an S corp for syndication. For us, an S corp has a different role. Um, some people may say that an S corp should never hold real estate. I'm sure there are situations where you might find that not to be true. So it is an option. You could even have a C corp. There are options available to you. It depends on your business strategy. It depends on the structure that you're going with. Pros and cons to all of these. But I'm going to talk about a structure that has four different LLCs in it, and I'm going to tell you what the purpose of each one is. So this is the structure that you guys are going to see from us at Freedom Venture many, many times. Very often, when we put out a syndication, the first thing that we'll do is we'll have a holding LLC. So one LLC that has one job, and that job is to hold title to the physical real estate. This is going to have a very simple tax reporting structure, if any at all. Sometimes, or most of the time, we can actually report these activities on the LLC above it because it only has one owner in this LLC, and that's the syndicate LLC. This syndicate LLC is going to be the most complex of the LLCs in this structure because this is where all the capital flows in and out of. This is where the limited partners have their ownership. This is where the GP has their ownership. So this is going to be taxed as a partnership. This is that syndicate LLC. Some people may not have this holding LLC, and you may just have this syndicate LLC. Again, pros and cons. This is a structure that we like. We like to keep things separate. It makes it very clean. And then, an additional two LLCs that you may see out there, and certainly something that we will very often do is have a GP LLC and a management LLC. And we structure this for tax efficiency. So if you're someone looking to create your own syndication and raise capital, and you get to a certain point, this may be something that you want to consider because if you're a GP, this is where you're going to own your ownership of the physical real estate. So your carried interest, those performance incentives that we talked about, you're going to get that into your GP LLC. So if you have a few different partners in your GP LLC, you can dictate how those profits are distributed within that LLC. However, management fees can go to a management LLC, and that management LLC can be taxed as an S corp. So that can maximize your tax efficiency on your management fees as well as your carried interest into the partnership LLC. It looks a little bit complicated, but I promise you it's really not as complicated as it looks. And we just went over these. I will just pop these up there so you can see it on paper. The syndicate LLC owns the holding LLC. It's the sole owner of the holding LLC. It's where partners hold their ownership stake, and then the GPLC manages how profits are distributed among the GPs. And then the management LLC, again, for that tax efficiency of the management fees, something very common that you'll see with some larger firms out there as well. A very basic concept of tax planning when it comes to real estate and syndications. It's just the timing of income and deductions. When is it appropriate to actually take advantage of these deductions, take advantage of these, if you can push the income to the following year, or move it up to accelerate it to the current year. Sometimes you're not going to be able to have these options, but you want to know the options that are available to you. So the timing of income and deductions, this is mastering the timing of income recognition and deduction claims is crucial for maximizing tax efficiency in a real estate syndication. So deferred income, accelerated income, those are both strategies that you can use in various situations. Let's say, you have a property that you're leasing up and it's getting towards the end of the year, and you don't want to recognize that income in the current year, you could offer a free month to your tenant as an incentive to get them in the door and then push that income onto the next following year. Potential way to defer your income there. Various ways to accelerate income to the current year as well, which we will show in the next slide. Deduction timing strategies. So there are immediate deductions that you can take. Cost segregation will accelerate deductions that you would have had over the useful life of the investment. We can now speed that up for certain parts of a property. And then the choice between accelerating or deferring income slash deductions should consider current tax rates, anticipated future income, and the syndicate's overall financial strategy. The goal is to align tax planning with the cash flow needs and investment growth objectives. Again, this is basic tax planning concepts, something that you would work with your CPA on, just making sure that we're maximizing the efficiency of our property, our portfolio, our lifestyle, whatever it is that you have going on, you're working with your CPA to make sure that you're, maximizing, all of the options available to you. Here's a quick scenario. If we were doing a syndication for a residential development, so maybe this is condos for sale. If we were doing some pre-sale agreements during the year one, we would be collecting deposits and partial payments from those buyers. So we'd be collecting income in year one. However, we would actually report that income in year two, which would actually be potentially more beneficial if we had, more expenses in year two. Maybe we had some things going on with the property that would make that more of a favorable tax position, whereas we would have had to pay on those taxes in year one, where maybe we didn't have as many options available to us to reduce that liability on that income. A lot of text on this screen. I'm going to leave it up. You guys can take this down later when you guys download this presentation. This is a big one. So for a lot of people that invest with us, they're investing as limited partners, and they're investing through, and what they are essentially getting is they're getting passive income on these properties. You've heard of passive income, but passive activity losses is something that a lot of people hope to get when they invest in a syndication, and they may not actually qualify um, to use those losses against their active income. To say that differently, if a property generates losses through a syndication, that's considered passive. It's a passive investment for you. The losses are considered passive as well. And those passive losses can only be used to offset other passive income activities. So if you have other activities, other passive investments that are generating an income, you can use these passive losses against that passive income, but you wouldn't be able to use it against, say, your active income, your W-2 income, things of that nature. However, if you are a real estate professional, if you're someone who qualifies as a real estate professional, you can bypass this rule. It's a way of getting around this rule. It's a way of allowing those passive losses to actually be applied to your active income, because your active income is generally being accumulated through real estate activities. So it's a really beneficial status to hold if you fit this status, it's very beneficial. And here's how you qualify. So to be considered a real estate professional, an investor must spend more than half of their working hours and at least 750 hours per year in real property trades or businesses in which they materially participate. Now, if you are, maybe you're a full-time passive investor, maybe you're looking at properties all the time, maybe you're a real estate agent. You don't have to be this. This is not an official license that you hold. This is a status that you can file for once you meet the criteria. Again, this is something that you're going to want to talk to your CPA about because the IRS will scrutinize this one. They will want to see documentation. If you're gonna go for this test, they're going to want to make sure that you actually qualify because it's that significant of a benefit. That's why they're going to want to, make sure that you've got your ducks in a row. And there it is. The IRS closely scrutinizes claims of real estate professional status due to its tax benefits. Proper documentation and adherence to IRS guidelines are essential. All right. Now we're going to get into the depreciation. This is a big, I have this conversation with people all the time. A lot of people understand depreciation at its basic, because a lot of people maybe, they own their primary home, they understand what depreciation is, but investing into a syndication is going to come with more complexities. It's going to come with more options, and you're going to be working with CPAs that their full-time job is to do cost segregation analysis. Their full-time job is to manage depreciation effectively on large scale commercial assets. And it's going to be different between residential and commercial. You can see right here in this chart, I put down 27 and a half years. I'll go over what this means in a second, but 27 and a half years, that applies to residential. 39 years is the useful life of a commercial asset. And, these things can always change. So it's something that you're going to want to closely watch. But depreciation at its core is a tax deduction that allows real estate investors to recover the cost of an income producing property over its useful life. Essentially, it acknowledges that the property over time wears down, becomes obsolete, or gets used. How does it work? There's a property cost allocation. So in this example, in this chart here, let's say we buy a piece of property for $1 million. You're going to have to allocate that cost to the building value and also the land value because the land value will not count as depreciation. The government is going to say that the land, as long as it's not improved land, to be specific there, and we'll talk about that, the land itself is not going to wear down. It's not going to become obsolete. So you have to separate that from what you've purchased. So isolating the land value and determining what the building value is, that's going to give you your true cost here. Determination of useful life, it's going to depend on what it is you're actually investing in. So residential property, let's just talk about it as 27 and a half years. And then you're going to get that annual depreciation deduction. So if we had a building value of $800,000 and our useful life is 27 and a half years, we can depreciate that $800,000 over the useful life of 27 and a half years, giving us an annual depreciation potential of $29,091. That is the basic of what depreciation is in a conceptual matter. Why does this matter? This matters because this is tax savings. This is cash flow enhancement, and this is investment longevity. This allows you to, continue to make proficient investments. But you're going to see very quickly here why this is such a significant tax savings. And then cost segregation. Depreciation is great by itself, but cost segregation is really where the money's made when it comes to depreciation. Cost segregation, you can associate this keyword with accelerated depreciation. Basically, what it is, cost segregation is a strategic tax planning tool that identifies and reclassifies property components and improvements to accelerate depreciation deductions, thereby reducing taxes and increasing cash flow. So how does it actually work? Well, first is going to be a property component analysis. So you're going to work with someone who's a professional in cost segregation analysis. They're going to look at all the items and that go into the property that you purchased, and they're going to identify things as personal property. This is furniture, fixtures, things that they can identify and separate from the building value as personal property. They're going to set those aside, and then they're going to reclassify those as a different classification of assets. So that's really what a cost segregation is. It's segregating the costs and the different assets associated with what you've purchased. Now, by separating these assets, they're going to be classified into different categories. where instead of depreciating them over the 27 and a half years that the entire building is going to be depreciated over, you can depreciate these individually categorized items over either 5, 7, or 15 years. So we're bringing that timeline way down for these individual items. So we're increasing the amount of deductions that we can take in the earlier years of owning this property. Because let's be honest, we may not hold on to this property for the full 27 and a half years to fully maximize the deduction benefit, the depreciation benefit. So by accelerating some items within the building and separating those out and bringing them closer, we're going to be able to capitalize on more of that benefit during the actual time that we own this building. And then again, the benefits, it's tax savings, it's improved cash flow, and also it's strategic asset management. Once you go through a cost segregation study on a building, you are going to know every single piece of your building. Trust me, you don't know your buildings until you go through a cost segregation analysis. It is separating every single item, it's knowing everything in there. So this is going to improve your asset management because you know every single piece of your building. You're going to know what needs to be replaced soon. You're going to know all of these things. It's just going to help. Knowing your building better is going to help you manage it better. All right, so two scenarios side by side. The straight line method is what we're talking about with just depreciation by itself, and we're depreciating straight line across the 27 and a half years. So that annual depreciation that we talked about, that $29,091, that's from our first scenario from the depreciation slide. $1 million purchase price, we separate the land value from the building value, and then we take the building value and we depreciate that over 27 and a half years. So it's just 800,000 divided by 27 and a half years. That's how we get the annual depreciation number. Very, very simply. Cost segregation study, same scenario. Purchase price, $1 million. We separate the land value, $200,000. And then the building value, now it's $500,000. Why? Because we did a reclassification of the assets and we said, okay, there's $300,000 worth of furniture, fixtures, what have you, personal property that's associated in this building. $300,000 that is no longer part of this building value number here, and we're now going to reclassify it down here. Now, once we've reclassified it as, yes, it falls into the cost segregation study component, we've reclassified it. We need to determine what those years are going to be. Like I said, some of these items can be 5 years, 7 years, or 15 years. For this example, I just showed a 5-year property. So out of that $300,000, let's say $150,000 of it was assets that can be depreciated over 5 years, and another 150,000 is components that can be depreciated over 15 years. All right, so that for the 5 year, that's $30,000 a year in depreciation, and over 15 years, that's $10,000 a year. So looking at this scenario in its entirety, it gives us an entire first year depreciation of 58,182 versus the 29,091. We almost doubled our depreciation benefit by doing this cost segregation analysis. And I'm just going to go over this one more time so you understand because this is a big topic. We're taking the $30,000 a year, one of these years, we're talking about the very first year. So 30,000, 10,000, and then the remaining depreciation of the building value. So this 18,000, this is that 500,000 spread across the 27 and a half years. That's 18,000. So we're still capturing it in the first year. Nearly doubled our depreciation benefit. Very significant. You can understand once you get into assets that are, $50 million, this is substantial. This is going to really impact all of the investors, all of the partners, all of us that are involved in one of these projects. We're going to want to see this, and we're going to want to understand, what is going on with the cost segregation analysis and what our benefits are really going to be, and how is this going to impact our taxable exposure as individuals. What are we going to see at the end of the year when we get our K1s? That's what we want to know. Bonus depreciation. This is another aspect of depreciation. Like I said, depreciation is extremely layered. There are so many different ways to look at it. There are so many different rules and ways that you can utilize depreciation. Bonus depreciation is another aspect of that, and it is a tax incentive that allows property owners to immediately deduct a significant portion of the purchase price of eligible assets in the year that are placed in service, rather than depreciating those assets over a longer term. So just like we talked about with cost segregation, we're separating assets within the building, we're separating those components, but instead of spreading it out over even the 5 or 15 years, we're immediately allocating it to the first year. So you can majorly impact the depreciation in your initial year of owning the property. Major, major incentive. Depending on what else you have going on in that tax year, this could be a lifesaver. This could be something that, significantly reduces your overall taxable exposure. But there are conditions that apply to bonus depreciation, like everything that we're talking about here. There's a lot of conditions. It applies to new or used personal property such as equipment, appliances, and furniture, and certain improvements to the interior non-residential property. And we're kind of in the middle of a change right now. We had between 2017 and 2023, there was a rule that allowed for 100% of all qualified purchases. That has decreased in 2023. It's decreased again this year for 2024 down to 60%, and that'll continue to decrease, and then 0% in 2027. All this stuff can change. We always know that. New things come around. This is something that could change in the near future. Who knows? But it's something that you want to be aware of, that it is an option. And the other thing that I want, before I go into the next slide, I want to talk about depreciation recapture, because I know there are people on this call that are going to ask about it. It's not something that I'm including in this slide, in this presentation, because it's a little bit more complicated. But the concept is this: depreciation works in your benefit while you own the property, but it works against you when you sell the property. So depreciation recapture is, let's say we, had a lot of depreciation, and we reduced our cost basis. Now, when we go to sell that property, because we reduced our cost basis so significantly, we're actually increasing, our on paper capital gains to the government. So they're going to ask us to pay back some of those depreciation that we've already paid. Now, this is a caveat for the people on this call that are asking the question. And it's going to be different for different situations out there, but it just emphasizes the importance of proper planning and understanding the business plan that you have associated with that property. That is going to be the responsibility of the GP and the accounting firm that works with the GP, to make sure that that is not an issue where the GP is suddenly going to have to pay a big tax bill at the end, and into the life cycle of the investment. That's something that, especially like if we were running the project, if this is a project that you invested with us, we would understand when we're trying to sell this, and picking and choosing which deductions to take during any given year is part of that tax planning that we're talking about. Because we have a business plan going in, we may not take every single benefit that's given to us early on, because we know with where we plan on selling this property at, we would have to pay back a certain amount. Sometimes it's worth it, sometimes it's not. So it just depends on the individual situation. But I need to put that caveat in there that depreciation recapture does exist, and it does work against you when it comes time to sell the property. So it is something to be aware of, and it's a good question to ask any GP that you invest with, what their plan is for managing depreciation and all the tax benefits associated with the investment. Some of the other deductions that are extremely common that most people are aware of from, owning their property, from owning rental properties in their market, interest expense, repair, maintenance deductions. These are all things that reduce the taxable income, and this also improves the cash flow of an investment. So interest expense deductions: mortgage interest paid on loans used to acquire, construct, or improve a rental property, fully deductible, reducing the property's net income reported for tax purposes. Repairs and maintenance deductions. This is different from capital improvements. This is repairs and maintenance. This is cost for that's necessary to keep a property in good working condition, and they're immediately deductible in that year that they're incurred. But like I just said, distinguishing between repairs that are immediately deductible and improvements like capital improvements that are depreciated over time, that's crucial for maximizing your tax benefits. You want to isolate those two because they're very different, and you want to make sure that they're applied in the appropriate year and make sure that you're applying them in a year that's going to be the most beneficial for you. And some of the other deductions that you'll see, professional fees, paying your CPA, paying the attorneys, all of these things are very, very common deductions that limit your taxable exposure. Travel expenses, insurance, property taxes, and then again, the operating expenses, of course, on the actual property are going to reduce your taxable exposure for syndication. I'm just doing a quick time check. I see we got about a little bit over 10 minutes left. Um, we've got a few slides in here on tax credits. I'm not going to dive too deep on tax credits because, again, each one of these has its own specific requirements associated with it. Um, but I want you to be aware of what the tax credits are. Maybe you've seen an investment from us, in an opportunity zone, in different tax credits that are out there. So I just want you to be aware of, some of these next couple slides that are coming up. I'm going to go over them, but I won't dive too deep into these specific use cases. But some of the common tax credits out there, low income housing tax credit, rehabilitation tax credit. Rehabilitation tax credit that applies for a lot of historical properties. That's very common. Energy efficiency credits, extremely common. We've been capitalizing on this for years. We actually stay out of low income housing tax credits. It's not a space that we want to play in. It's out there and it can be very beneficial for a lot of people. It's just not our strategy at Freedom Venture. But it can be a great strategy. It can be great for a community. There's a lot of benefits to low income housing tax credits. The big difference between deductions and tax credits is that unlike deductions, tax credits provide a dollar for dollar reduction on the amount of taxes owed. All right, so the tax credits are extremely valuable. Deductions, they reduce the amount of taxable income. Tax credits, they actually reduce the amount of taxes owed. And then some tax deferral strategies. So tax deferral strategies are things like 1031 exchanges, self-directed IRAs, opportunity zones. These are strategies that you can use as an investor to pick the right syndication. We have very often had properties in our funds that continuously go through 1031 exchanges because we're looking to defer those capital gains. We're not trying to pay those capital gains. We're trying to keep capital working for as long as possible. And that also optimizes your investment equity because you know what happens once equity comes back to you. It's gonna go somewhere. You're gonna maybe spend it. You're gonna, buy something that you don't need. But through a 1031 exchange, you're increasing the longevity of your investment. You have to put it out. You have timeline constraints. So that capital's immediately going back to work. So that's beyond the capital gains part of a 1031 exchange. I love the 1031 exchange for the fact that it forces my hand to get capital back out the door. So the definition of a 1031 exchange, it's named after Section 1031, like all things in the tax code are. It allows investors to defer paying capital gains taxes on the sale of an investment property by reinvesting the proceeds into another like-kind property. Key features, like-kind, this is a very general term. It's going to apply to most real estate. Timeline requirements, I believe the current requirements are you have to identify a property within 45 days and then close on it within 180 days and continuity of investment. That's what I like about it, as well as deferring the tax gains. It keeps your capital working. And other deferred tax strategies are things like opportunity zones. Opportunity zones have been a huge hit for us the past decade, really. The past several years, we have properties that are in opportunity zones that we are in there for, 10-year holds on these properties, but we're able to defer the capital gains on these properties. It was a strategy that was employed to promote growth in certain parts of communities. We certainly have enjoyed participating in opportunity zones, and it has been a great opportunity for investors as well. And then self-directed retirement accounts. That's going to be the next thing that we talk about. A lot of people that invest with us invest through self-directed retirement accounts. I've invested with self-directed retirement accounts. Again, a lot of strategies that are available to this, but I'm not sure as many people know all of the different options that are available for self-directed retirement accounts. Like I said, it's extremely common. Investing in real estate syndications through retirement accounts such as self-directed IRAs or solo 401ks allows investors to leverage the tax advantage growth of these accounts, potentially enhancing the returns on their real estate investments. Some of these benefits are the tax deferred or tax-free growth. So if you're investing into you know, a self-directed IRA, you're going to be looking at, a traditional self-directed IRA. It's going to be tax deferred, but investing into a Roth self-directed IRA or a Roth solo 401k, that's going to be tax-free growth. So different strategies, different considerations. Um, Considerations here, we've got some prohibited transactions. So this would be the IRS doesn't want you to, be using these funds for anything that would be personal use. So investment properties, syndications, completely acceptable. Using a self-directed IRA to buy a vacation house, not going to work. UDFI and UBIT taxes. So this is unrelated debt finance income and unrelated business income tax. This is something that you're going to want to talk to your sponsors with. If you're investing with us, we will always bring this to the forefront so that you're aware if you're investing if you're investing with a retirement account. It's something that you're just going to want to be aware of. We can't make advice on if it's going to impact you. It's just different if retirement accounts will have different requirements, so you're going to want to be aware of those. And then custodian requirements. Through these self-directed vehicles, you're going to have to work with a self-directed custodian. Each one's going to have their own requirements. They're all going to have some sort of fees required. They're usually not too bad. $100, a year might be the most that you'll pay sometimes. It just depends. But if you work with the right custodian, you should be able to, depending on the retirement account, get check writing access, so you can make decisions and you can actually make investments without going through them. Sometimes you just have to go through their process and you have to fill out their paperwork. Sometimes it can be a bit tedious. Again, there are a lot of custodians out there. If you book a call with me, I'm more than happy to give you a few recommendations and even make introductions on different custodians that have worked really well for our investors in the past. Skipping over a few slides, this is just I'm going to talk about a few scenarios about to wrap up this webinar with the time that we have to kind of bring it home. If we have a scenario where an investor is looking to expand their real estate portfolio and sells a property with substantial capital gains to reinvest the proceeds and defer capital gains taxes, they utilize a 1031 exchange, carefully selecting like-kind property that aligns with their long-term investment goals. So what does that actually do? It defers tens of thousands of dollars in capital gains taxes, leveraging the full sale proceeds into a new property that hires a higher rental yield and potential for appreciation. Another scenario, again, we're just talking about the things that we've already talked about. Why would someone choose an LLC? If a group of investors, they choose an LLC for its that flexibility and profit distribution, liability protection, the outcome, it not only protects the individual investors from personal liability, but also provides each member with the ability to claim their share of the depreciation and mortgage interest deductions, again, reducing their taxable income. After acquiring commercial property, an investor conducts a cost segregation study identifying assets that qualify for accelerated depreciation. This includes part of the building's HVAC systems, exterior landscaping, certain fixtures, which are then depreciated over 5 to 15 years instead of the standard 39. That's 39 for a commercial asset, remember. Residential is 27.5, commercial is 39. The accelerated depreciation results in a substantial decrease in taxable income for the property in the initial years following the purchase, improving cash flow and allowing investors to recover their initial investment more quickly. We'll get to answer some of these questions here. I think I've answered most of them. But quickly, just going to hit on about Freedom Venture Investments. For those of you that are with us for the first time, it's a great chance to meet us in this format. This is our mission statement. It started as myself, Dave Seymour, and Walter Novicki, and we realized a simple truth that we could achieve much more together than we ever could alone. What began as just the three of us has now grown to over 500 partners. So we thank you to all the partners, and we look forward to long-term partnerships with all of you. This is where we stand currently, founded in 2019. Dave and Walter have been in business much longer than I have. I got my start in 2016. Walter has 35 plus years in the industry. We closed out a few funds in our first couple of years. We are now over 350 million in equity under management, over 500 million in portfolio growth. Average gross IRR 22.14%, and we're well over 1,600 units at this point. States that we invest in, we like Texas, Tennessee, the Carolinas, Georgia, and Florida. These are states that we currently hold properties in, and there's one common theme in all these states. We have boots on the ground in all of these states. Wherever we have invested, we have local relationships. So a lot of our properties, we've got a high concentration in Florida. I've got a place down in Florida. I spend a good amount of the year down in Florida. Walter lives down in Florida. In the states that we invest in, where we aren't physically located, we have partners that are located there. We have people that are there. We have been to every single one of our properties and we go to them on regular basis. Some open funds that we have, very basic private lending fund. It makes investments as secured debt obligations. This is investing in mortgages, basically. We're investing in first lien positions. Lower minimum investment for this fund. Target annual return 9%. This is an attractive fund right now. We're seeing some pretty strong yield in the current debt environment. Balanced Income Plus Fund is our flagship fund. This is a very well diversified fund. It has some development projects, some cash flow projects, and also some debt yield in there as well. And then the Suncoast Growth Fund. This is our fund that's focused on development projects exclusively, minimum of 4-year hold, and then continues on the cash flow after that. All these projects are quarterly distributions. And then beyond our fund options, like what we talked about today, we have syndication offerings. These are asset-specific investments. So instead of investing into a blended portfolio of assets, you can pick and choose which properties you'd like to invest into. These options are always available to you as well. Again, pros and cons to both strategies, but there's a lot of testimonials on our website. We're more than happy to connect you with current and past investors if it's something that you're interested in. These are some of the next steps that you should be taking after attending this webinar. Start, looking at different opportunities available, whether from us or other syndicators out there, and sit down with your CPA and just talk about how this investment might impact my overall financial picture, how this might change. Stay updated. Always be looking at the different changes in the regulatory environment. Maybe consider joining a mentoring group or investment group. Meet people in your local community that are doing these types of investments. And as always, you can visit freedomventure.com for continual learning and resources. Our education tab has a ton of blogs in there, a lot of resources available to you guys. As well as on our website, you guys can go to freedomventure.com and you can schedule a call right on our website, or you can fill out our application to join our investor club, and then you'll be able to start actually seeing some of the opportunities that we have available and see if any of them make sense to you guys. So I'm just gonna see if I can answer a couple of these questions that are still on this. So let's hit a couple of these while I've got a couple of minutes here. All right. Can a cost seg item with a shorter life, 5 years, be repeated every 5 years or one-time depreciation for the usual 27.5 year period? I think if I understand what you're asking here, you're asking about the individual items for the cost segregation that have a shorter lifespan, 5 years. So just to be clear, once something is allocated to its individual category, it is categorized for 5 years, and then it can be depreciated on that 5 years. So, yeah, yes, it is now spread out through those 5 years. It's not like if we're just talking basic cost segregation, you would just take that, say, let's say it's $100,000 that is allocated to the 5 year period. That would be $100,000, and then divide it by five. So you could take that $20,000 deduction each year. I hope that makes sense. And I think that answers your question. Um, but yes, it's so you got to keep the two separate. It's the building, which is 27 and a half years. And then once you've categorized it into individual periods, then it is, you can depreciate it over those periods. Yes. So this question is, do you use a different LLC for each investment? We do. So if you're in buying properties, they're buying rental properties in your local market, that's, you can probably get away with, if you were just buying, this is an asset protection question more so than tax planning strategy. You can get away with buying properties with one LLC. That again, that's a question for your estate planning, your tax planning, your risk mitigation, all that. There are pros and cons. The way that we do it, especially with having multiple investors on all of our projects, we have multiple LLCs for each and every individual investment. So that creates a very complicated tax picture for us at the end of the year. But we have accountants that their full-time job is to manage those books. If you're going out and buying individual properties yourself, and you're the only person in those projects, yeah, there are some benefits to keeping some separation. But as far as the tax structure goes and what we talked about here, you're getting a lot of the benefits of the LLC, the same benefits that you would get through one LLC that you would have it with multiple LLCs. Let's see. Oh, this is a good question. Do hours spent on continuing education like this webinar count towards qualifying? Yeah, absolutely. This is part of your job. If you're a real estate professional and you're training yourself by attending webinars like this, that's documented hours that you spent towards your profession. Whatever it is that you're doing for you to qualify as a real estate professional, going out and looking at properties, driving around in your community, looking at properties, looking at listings. These are things that all count. How you document those things, that's going to be up to you, and making sure that you're doing it all to be in compliance. But attending these webinars is a great way to do that. What about the LLC in a partnership? I'm just looking through. There's a couple questions in here that I'm going to answer personally, because there are some very specific questions here that apply to individuals, and they're not going to be applicable to other people. Tom, I will get back to you. I will reach out to you directly. Here's another great question. So this question is, where does depreciation show up on the K1? So depreciation on the K1, it's gonna, it's that the K1 is also known as the Form 1065. And it's handed out at the end of every single year, and it's going to be reported under box, I think it's box two. You're gonna you can look this up online, but I believe it's box two, and it should be titled Net Rental Real Estate Income or Loss. And that section is going to reflect the share of income or loss from rental real estate activities, and that's going to include the depreciation expense allocated to each partner. So you may not see specifically, the line item, but you're going to see it reported on the K1 as reducing the net rental income, or increase, or the net loss, essentially. So what's passed through onto the partners and members, that's where you're going to see the depreciation show up on the K1. Um, yeah, great question. All right, guys, we are wrapping up. We are a little bit over as of right now. There are some more questions here. I will answer all of these questions directly through email for all you guys. I really hope that this was a beneficial webinar for you guys. I definitely enjoyed it. Like I said, it's not a topic that I focused on when I was first starting, but it's something that I've gotten really entrenched in, and I've learned a ton of things just by talking to investor partners like you guys. So please reach out, book a call with me. I would love to hear what sort of situations you guys are going through right now. Maybe you're selling a business, maybe you have things going on in your personal life um, that I could learn from, and I can share experiences that I've heard from other investors in ways that, we've navigated these things together. So thank you once again. I will send out the recording and I will see you guys next time.